Hi everyone, and welcome back to the channel. Today we're going to look at another application of the time value of money, and that is savings accounts. As a starting point, why should you invest in debt? Why should you lend your money to, say, a bank? Returns are generally lower than equities, and they certainly underperform equities over the long term. You are sacrificing capital growth for periodic income. Yet despite this, the fixed income market is substantially larger than the equities market. Why is that? We're going to look at it from the perspective of both the borrower, the issuer, and the investor, the lender. Firstly, there are more key players in fixed income markets. Governments, corporations, financial institutions, even supranational agencies such as the World Bank. These entities can raise money from society as a whole. There are simply more avenues, channels to borrow money from all sorts of investors, whereas company shares can only be issued to the wider public if the company is also public itself, which is a very expensive process to set up. It's called an IPO, initial public offering. Otherwise, private companies are prohibited from selling their shares in the public domain. Their other options are to sell the shares privately to institutional investors, a mechanism known as private placements, or authorize a rights issue in which new shares are issued to existing shareholders, or on a much smaller scale, issue shares directly to individual investors, such as a family-run company. We mentioned sovereign nations. These are countries that raise an enormous amount of debt to fund the country's needs, be it infrastructure, education, our healthcare system in the UK, and now the nationalization of our railway system. The amount of costs it takes to run a country far exceeds that of any individual company. Companies also prefer to issue debt than equity, as it is a cheaper source of finance. Lower risk means lower returns. Plus, it is also a tax shield. For example, in the UK, the highest corporate tax rate is 25%. So that means £1 of interest costs the company 75p. You can't do that with dividends, because dividends are not treated as a tax-deductible expense. They are an appropriation of profit. Finally, bonds, notes, and treasury bills, which make up the vast majority of securities in the fixed income umbrella definition, have an expiration, so they are constantly reissued. Okay, so what about the benefits for investors? Well, when it comes to investment risk, we think of volatility, your daily swings. By how much do the returns fluctuate over time? Are they volatile or are they stable? Well, debt securities are far less volatile than equities, so it attracts investors who are risk averse. Secondly, the coupon payments, the interest payments, are as guaranteed as can be. Obviously, it depends on the credit rating of the issuer. In most cases, there is a high level of certainty that the borrower will honor the periodic interest payments and capital repayment at the end. Even if the company defaults and is liquidated, debt holders get preferential treatment over shareholders, so the risk of loss is also lower. In the case of savings accounts, they are FSCS protected up to £75,000, meaning your capital is insured in the case of default. Sure, many banks can share the same license, but nothing is stopping you from opening multiple savings accounts across different licenses. Unlike savings accounts though, bonds are not insured. Lastly, they are great for diversification. One of the first things they teach you in portfolio risk management is the notion of correlation. Take a mutual fund, for example, that holds thousands of equity securities, each with different market capitalization. We know that the return of the portfolio is the weighted average return of the underlying investments. But what about the risk, or the standard deviation per se, of the portfolio? Is it also the weighted average standard deviation of the underlying investments? Well, turns out it's not, because there's a new dimension at play, and that is covariance or correlation. We calculate the covariance of each pair of securities. So for example, if we have two securities in a portfolio, we have a total of 4 combinations or terms. If we have n securities, then we have a total of n squared combinations. I'm not going to get into the mathematics because that's a whole video in itself, but the idea is that if you have one security with a high return, high risk, and combine that with another security with low return, low risk, the average return is a combination of the two, and so is the risk. At the right mix, you can significantly reduce the risk without sacrificing much of the returns. The overall risk can be reduced even further if the securities have no correlation or even negative correlation, meaning each security moves in opposite directions, such as the case of equities and bonds. When equities perform well, bonds tend to underperform, and vice versa. By constructing a portfolio of assets that do not move in the same direction, you can minimize the ups and downs of the market whilst maintaining steady growth. Essentially, diversification makes a portfolio more resilient to market risk. I highly recommend you check out this article from Vanguard when you get the chance. But I just want to demonstrate a chart from the article for a moment. The y-axis are the cumulative returns of equities during these events, and we can see that they were quite severe, it's over 10%. And the size of each bubble corresponds to the length of those periods. We can see that the longest lasting shock to the equity market was the dot-com bubble and 9/11 terrorist attack, roughly 45% fall in the market, although the global financial crisis hit the hardest, roughly 55% drop. But look how bonds have performed during that same period. So the cumulative return for bonds are shown on the x-axis, and they actually did remarkably well. And for example, in the 9/11 crash, bonds actually rose by 25%. And this is exactly what we call a very strong negative correlation. And the same principle applies to all these other events in the top half of the graph. Out of all the hard crashes, the 2022 global energy crisis and Russia's attack on Ukraine has been one of the rare circumstances in which both equities and bonds took a nosedive. We call this a very strong positive correlation because they both moved in the same direction. So it definitely can happen, but it is less common. Bonds and equities are usually known to have negative correlations, which make them great for diversification. To get the most diversification for as low a cost as possible, you should consider mutual funds, such as the highly popular Life Strategy Fund or their target retirement funds. I will make a video in the future about mutual funds and how to invest in them and the sort of things you need to look out for. Or you could hold a mixture of a pure equity fund like the S&P 500 and then hold several savings accounts, which is what I like to do. You avoid having to pay management fees and whatnot, and unlike bonds, we said that savings accounts are FSCS protected. Before we continue, I'm not a financial advisor. This video is for general financial education and awareness. It is not financial advice. Please speak to a financial advisor for information tailored to your needs. Here's the other thing. For the love of God, don't hold large sums of cash in your current account, especially in this inflationary economy. You are burning through your own money without even spending it. Don't let your wealth depreciate because of your own ignorance, right? Make your capital do some work for you. Unless you're expecting a large payment in the foreseeable future, don't leave it in your current account earning zero interest. If you make frequent payments, then charge them through a credit card so that you can pay it as one lump sum at the end of the month, preferably after payday. Unfortunately, they don't teach you this stuff in school. Hell, not even in finance qualifications. Okay, so now we can explore some savings accounts and how they work. There are a few key areas that you need to be mindful of. Whether it's a fixed or a variable interest rate, whether there are any withdrawal limits, and what is the interest payment frequency? Is the interest paid monthly or upon maturity, which is at the end of the offer period? And what does AER mean? So AER stands for Annual Equivalent Rate, and it is the 12-month interest rate earned taking compounding into effect. We will go through a couple of examples to make this clear. Now over here, I've compiled a list of the best interest rates you can get from savings accounts in the UK as of June 2025. I've got it split between fixed and variable rates and the fixed period where applicable. The file is available for download in the description box below. Fixed rates are less flexible because it is essentially a time deposit. You cannot access the cash for the stated period, so it may not be the best choice unless you are certain you don't need the money during that time and you are worried rates might fall later this year, which is highly likely. Take Nationwide for example, which I've got ranked as number 1 in terms of interest rate. 5% is pretty good for 18 months. If you invest £1,000, you will get £76.25 at the end. If it's £10,000, then you get 10 times that. So that's £762.50. Pretty darn good. However, 18 months may be a long enough time for the stock market to appreciate and create a good enough buffer between your principal investment and daily market volatility, i.e. the capital appreciation is greater than the market risk. What I would do, if and only if I know I'm not going to use the cash after 18 months, is to put it in the stock market. At the start, you will likely make losses, but over a long enough period of time, you will likely generate a profit. The question is when, and will it be higher or lower than this savings account after 18 months? I must reiterate, unless you know you won't need the cash after 18 months and potentially longer, consider the stock market. Otherwise, go for nationwide, especially if you're an existing customer. In fact, if you put your cash in the S&P 500, which is the gold standard for index funds, again, I will explain what funds are in another video. So this one in particular is from Vanguard, and it's for UK investors. In this case, I've got it dated in the 18 months to end of May. So that's from 2nd of December, 2023, until the 29th of May, 2025. Markets are closed on weekends and holidays. If you had invested £1,000 at the start, in which the net asset value opened at £67.92 and closed at £83.52, you would have made a cumulative profit of 23% before fees. So that's £231, which is much higher than the £76.25 with Nationwide. In fact, that's over 3 times as large. So that's roughly 15% annualized return compared to the 5% return from the bank. However, I cannot stress this enough. Investing in equities is a long-term strategy. You have to play the long game because past performance is not a reliable indicator of future results. The other good news is that the S&P 500 can be bought at a discount compared to the start of the year. You can thank the Americans for self-inflicting their own markets, especially the staggering incompetence and ignorance from the Trump administration for damaging the global trading system. So, if you take a 3-month average at the start of the year, just before the dip, I'm just going to do it very crudely and say it's £92.27, that's roughly 9% discount compared to the end of May. Now, if you want to access the cash every now and then a variable savings account is the way to go. Considering the difference between fixed and variable rates are so marginal, you honestly won't be missing fixed rates, at least until next year. However, before we continue, I want to briefly suggest First Direct, which I've personally used in the past. So this is a monthly top-up, essentially an annuity, and the maximum you can contribute is £300 a month. If you do that for 1 year, you'll earn interest at £136.50, which is pretty good considering this is not a one lump sum investment. So it's definitely less noticeable to your bank balance, and you're not obligated to contribute each month. But do bear in mind that whatever you put in gets locked away for 12 months. It's a very good setup in my opinion. I wouldn't bother with Principality at all. So Principality has a knack for offering high interest rates every now and then because it catches a couple of headlines. But it's completely for show. It has very little utility. So the maximum monthly contribution is £200. So if you do that for a fixed period of 6 months, the interest at the end is a resounding just over 25 quid. Not even avid savers would take them seriously. Come on. Invest with First Direct instead, or Nationwide, or Hampshire Trust Bank if you don't already hold a Nationwide account. We'll go through the calculations in the individual tabs in a bit. For some of them they are fairly straightforward and I've just showed them here on this page. Going back to variable rates, CHIP is the best one right now, and I personally use that. Again, do not leave large cash balances in your bank current account. You earn nothing on it and its value gets eroded as the prices of goods and services continue to go up. I've also used Barclays Rainy Day Saver in the past. It used to be around 5% and it's been around since COVID, I believe. The rate will fall to 4.36% from August, and there's a 5k investment limit, but it's still pretty good as far as variable rates go. I would not bother with Moneybox Cash ISA. Their headline figure of 5.46% is only available for the first 3 months, after which it falls down to 3.85%. And it's far too restrictive given it's a variable rate product, because after 3 withdrawals your interest rate is capped at 1.5%. Otherwise, in terms of monthly contributions, Cooperative Bank is the clear winner. Obviously, no withdrawal limits is a key advantage. Now, at the time of shooting this video, you will not find anywhere on the internet, nor in any finance textbook, how the interest payments quoted by banks are calculated. This comes from my understanding of the mathematics of interest and debt investments, so I would greatly appreciate if you showed your support by liking the video and subscribing to the channel. The calculations themselves are actually quite simple. Once you wrap your head around mortgages, you can pretty much work out any other debt product in the market. Really, it is all based on the time value of money. By the way, just quickly, if you haven't had the chance, do check out my previous video on how mortgages work. I've also included for free a mortgage calculator, which is the best free mortgage calculator on the planet. Certainly in terms of ease of use and elegance, but without compromising on the complexities of mortgages. The results from the calculator is identical to the results you see in mortgage comparison websites like Compare the Market and LNC, but it also works out for you the cash flow schedule from a monthly and annual perspective using the graph. You can also work out the cost savings if you were to fix compared to what you're paying now. By the way, that is all explained in the mortgage video. Finally, not all comparison websites provide rich information such as compare the market. So the calculator that I built can be used to bridge that gap to allow for easier comparisons. So when it comes to calculating interest, you generally have two options. You can either use a spreadsheet, which is the most flexible and recommended approach, or you can do it mathematically. In finance, rarely do we incur a single transaction for any investment. We often have multiple transactions. In mathematics, we call that a series. The question is, what type of series is it? For example, is it an arithmetic series or a geometric series? By the way, I've introduced this page in my previous videos. It's from my formula book when I studied physics at Cardiff University. It is a great summary of the entire fixed income market. If you just think about the debt market for a moment, bonds, notes, bills, loans, leases, commercial paper, mortgages, mortgage-backed securities, the list goes on and on. Virtually all debt products are driven by the mechanics that you see on this page. For example, the Taylor series is used in bond statistics in deriving the closed form Macaulay duration and bond convexity. Essentially, this one-pager is worth trillions and trillions of dollars, which is quite remarkable. So, if you are a uni student, don't throw away your material. You never know when you might use it again. Going back to First Direct, the interest rate is 7% payable at the end. So that means there is no compounding. Whenever you see the gross rate equal to the AER, that means there is no interest on interest. In this case, each month we are contributing £300 to the account. The actual months are irrelevant because what is often the case is that these banks and building societies make a number of assumptions when they quote the interest payment. In this case, the total number of days is 365, and that is spread evenly throughout the year. So that means each month is approximately 30.42 days. So essentially, you are accruing interest each month, but it is not credited to the account until maturity. Again, the file is available for download, and you can have a look at the calculations in your own time. For those who are curious about the mathematics, we iterate each month. The first £300 will earn interest for 12 months, the second £300 will earn interest for 11 months, and so on. I've used sigma notation to shorten the expression. These two are essentially the same. The left-hand side is the sum of the first n natural numbers, given by this closed form expression. The right-hand side is a more general expression, taken from the formula book. It does not matter which one you use as they are essentially the same. After some algebra, you get the expression at the end, which is the £300 monthly annuity times the annual interest rate times 6.5. The calculation for Nationwide Flex Regular Saver is exactly the same, with the added caveat that by the fourth withdrawal, the rate drops down to 1.5%. And you can see that over here. In my first video, where I introduced the time value of money, I mentioned the exponential function e to the x, in which e is an irrational number equal to 2.7182 to 4 decimal places. We said that the exponential function is the limit in which the interest is compounded an infinite amount of times over a given period. In this case, it's 1 year. If the product pays simple interest at 7%, then this is what the shape of the function would look like. It's simply a straight line growth with a gradient equal to the interest rate. And this is what the exponential functions would look like, with e being the steeper of the two because it has a higher base. However, notice that over a small period of time, both exponential functions mimic the straight line. And we touched on that in the first video. When you apply the Taylor series, as the time gets smaller and smaller, these exponential functions approach simple interest. We also said that in the real world, transactions are discrete by nature. For example, a monthly transaction of £2,000 or £10 per day. Those are discrete transactions. When we use simple interest, or the ordinary exponential function, like 1 plus a constant to the power of x, we make the assumption that transactions are discrete. However, nothing is stopping you from making the assumption that transactions are continuous, infinite. In fact, in science, we rarely use this form. You almost always see e to the x. So let's try doing that. We will assume that interest is paid an infinite amount of times in a period, however small that value is. So if we let t is equal to 1 month, we can find the value of delta by taking the natural log of 1 plus 7% over 12, which is approximately 0.5816% per month. Mathematics does not care whether the bank pays simple interest at 0.583% per month or pays interest at every instant at 0.5816% per month. They are, for all intents and purposes, mathematically equivalent. We then apply the series of transactions logic that we used earlier, and as you can see, this is a lot more involved than assuming discrete interest payments like the one we used above. Clearly, the exponential function is not designed to handle discrete transactions, even though it can. We find that the closing balance is £3,736.50, and we can work out the interest by subtracting that by 3,600 over here. In much the same way, when you're dealing with continuous change, i.e. calculus, and even in statistics, you don't want to be using the ordinary exponential function, which is of the form 1 plus a to the power of x, which is designed for discrete data. You can use it, but it's going to make the maths more messy, so it is a matter of convenience. The Barclays one is a bit tricky because it's banded. You earn simple interest in the first £5,000, followed by 1% on the excess. So you do earn interest on interest, but at the much lower rate. Since part of the balance actually compounds, we use the geometric series. I won't go through the maths, but it's there if you're interested. Now, the cooperative bank and principality example is a more realistic scenario because it uses actual days in the month rather than calculating an average. And the calculations themselves are very straightforward, so I'm just going to let you look over them in your own time. Now, I've also included Virgin Money Regular Saver, which was offered around the same time last year. And I took a screenshot of it because I couldn't believe it at the time. They were offering interest at 10%, which is absolutely crazy. Unsurprisingly, this was taken off the market within a matter of days. Anyway, thank you for watching and I hope you find this video useful. Bye now.